Rule number 1, never lose money. Rule number 2, never forget rule number 1. This is one of the most famous quotes by Warren Buffett, the legendary investor and CEO of Berkshire Hathaway. It means that you should always focus on preserving your capital and avoiding losses, rather than chasing high returns and taking unnecessary risks. Hello and welcome back to my channel, where I share tips and tricks on how to grow your wealth. In this video, I'm going to show you how to invest in stock market in 2024, a 5-step guide for anyone who wants to start or improve their investing journey. Investing is one of the best ways to see solid returns on your money, especially when you start early and take advantage of compound earnings. But how do you get started with investing, and what are the best investment strategies in 2024? Let's find out. Step 1. Choose an online broker that suits your needs. To open a stock market account, you need an online broker that can execute your trades and provide you with the tools and resources you need to research and analyze the market. There are many online brokers to choose from, but they vary in terms of features, fees, customer service, and investment options. Depending on your investing style, goals, and budget, you may want to consider the following factors when choosing an online broker. 1. Commissions and fees. How much does the broker charge for each trade and for other services, such as account maintenance, transfers, or margin interest? Are there any hidden or unnecessary fees that can eat into your returns? Some brokers offer commission-free trades on certain assets such as stocks, ETFs, or options, which can save you money in the long run. 2. Trading platform and tools. How user-friendly and reliable is the broker's trading platform and mobile app? What kind of tools and features does the broker offer, such as charting, screening, news, alerts, research, education, and customer support? How fast and accurate is the broker's order execution and trade confirmation? 3. Reputation and regulation. How long has the broker been in business and how reputable is it in the industry? Is the broker regulated by the Securities and Exchange Commission and the Financial Industry Regulatory Authority? Is the broker a member of the Securities Investor Protection Corporation, which protects your account up to $500,000 in case of broker failure? Step 2. Decide how much to invest. As Warren Buffett, one of the most successful investors of all time, said, "Do not save what is left after spending, but spend what is left after saving." The amount you should invest depends on your financial situation, your investment goal, and when you need to reach it. A good rule of thumb is to invest at least 10% to 15% of your income for long-term goals like retirement. If you have shorter-term goals, like saving for a house or a car, you can invest less, but make sure you have enough cash in an emergency fund to cover unexpected expenses. For example, let's say you earn $50,000 a year and you want to save for retirement in 30 years. If you invest 15% of your income, or $7,500 a year, in a diversified portfolio that earns an average of 8% a year, you will have over $900,000 by the time you retire. That's the power of compounding. But if you invest only 5% of your income, or $12,500 a year, you will have only about $300,000 by the time you retire. That's a huge difference. Step 3. Pick an investment strategy. Your investment strategy should match your saving goals, how much you're investing, and your time horizon. There are different ways to approach investing, but here are some common ones. 1. Index investing. This is a passive strategy that involves buying and holding low-cost funds that track the performance of a market index, such as the S&P 500. This way, you can diversify your portfolio and capture the average returns of the market with minimal fees and effort. For example, let's say you want to invest in the U.S. stock market and you have $10,000 to start with. If you choose index investing, you can buy a low-cost fund that tracks the S&P 500, such as the Vanguard S&P 500 ETF, which has an expense ratio of 0.03%. This means you pay only $3 a year for every $10,000 invested. If the S&P 500 returns 10% a year on average, your $10,000 will grow to over $67,000 in 20 years after fees. 2. Value investing. This is an active strategy that involves finding and buying stocks that are undervalued by the market, meaning they are trading below their intrinsic value. This way, you can profit from the price appreciation when the market recognizes their true worth. For example, let's say if you choose value investing, you can buy individual stocks that are trading below their fair value, such as Apple, which has a price-to-earnings ratio of 28 compared to the S&P 500 average of 40. This means Apple is relatively cheaper than the market given its earnings. If Apple grows its earnings by 15% a year on average, and its price-to-earnings ratio stays the same, your $10,000 will grow to over $163,000 in 20 years, before taxes and commissions. 3. Growth investing. This is another active strategy that involves finding and buying stocks that have high growth potential, meaning they are expected to increase their earnings and revenue faster than the market average. This way, you can benefit from the rapid growth of these companies, even if they are trading at high valuations. For example, let's say if you choose growth investing, you can buy individual stocks that have high growth prospects, such as Amazon, which has a revenue growth rate of 37%, compared to the S&P 500 average of 10%. This means Amazon is growing much faster than the market, despite its high valuation. If Amazon maintains its revenue growth rate and its price-to-sales ratio stays the same, your $10,000 will grow to over $1.2 million in 20 years before taxes and commissions. Step 4. Understand your investment options. Once you have a strategy, you need to choose the specific investments that fit your goals. There are many types of investments, but here are some of the most common ones. 1. Stocks. These are shares of ownership in a company. When you buy a stock, you become a part owner of that company and can participate in its profits and losses. Stocks can offer high returns, but also high risks, as the price can fluctuate significantly depending on the company's performance and the market conditions. For example, let's say you want to invest in the technology sector and you have $5,000 to invest. If you buy stocks, you can choose a few companies that you like and believe in, such as Microsoft, Netflix, and Shopify. You can research their financials, products, competitors, and growth prospects, and decide how much to allocate to each stock. You will have to pay commissions for each trade, and you will have to monitor your portfolio regularly and adjust it as needed. 2. Exchange-traded funds or ETFs. An ETF is a type of investment that tracks an index, a basket of securities, or a commodity, and trades on a stock exchange like a stock. When you buy an ETF, you get exposure to a basket of investments that follow a certain theme, strategy, or objective. Funds can offer diversification, convenience, and cost efficiency. For example, you can choose a fund that invests in the technology sector, such as the Technology Select Sector SPDR Fund, which holds 74 stocks. You can buy the fund with one trade. However, you will have to trust the fund manager or the algorithm to pick the best stocks for you, and you will have less control over your portfolio. Step 5. Monitor and adjust your portfolio. Once you have your investments, you need to keep an eye on them and make changes as needed. You don't have to check your portfolio every day, but you should review it at least once a month or whenever there is a major change in your life or the market. Some of the things you should look for are: 1. Performance. How are your investments doing compared to your expectations and benchmarks? Are they meeting your goals and risk tolerance? If not, you may want to rebalance your portfolio or switch to different investments. 2. Fees. How much are you paying for your investments and your account? Are there any hidden or unnecessary fees that are eating into your returns? If so, you may want to look for cheaper alternatives or negotiate with your provider. 3. Taxes. How are your investments affecting your tax bill? Are you taking advantage of the tax benefits of your account? Are you minimizing the tax consequences of your transactions? That's it for this video. I hope you found it helpful and informative. If you did, please give it a thumbs up and subscribe to my channel for more videos like this. And if you have any questions or comments, feel free to leave them below. Thanks for watching and happy investing.